So, not only is inflation at record highs, the cost of gas, of petrol, of fuel is going up, the cost of food is going up, and now the Fed in the United States has increased the interest rates, and the Reserve Bank in South Africa has increased the interest rates. What are they thinking? Don't they care about us, people living in the countries? Well, there's a reason to why they are doing that, and I'm going to share with you why they are doing that and what you can do to shield yourself against these rising interest rates. So let's hop on straight into today's video. So before we talk about why interest rates are rising, I just want to point this really important thing out real quickly, and that's inflation, right? And I recorded a in-depth video on what inflation is and how it affects you and what you can do to benefit from inflation. But at a really high level, when we think of inflation, there's actually two primary causes. Number one, it's the demand pull of inflation. And what that talks about, it's where people have more money. And as a result of that, there's an increase in demand, which means there's less available. So they hike prices. So there's an increase in the prices. The second one is called the cost push inflation. And that's where the costs of things like raw materials and things like that are increasing, and there's no suitable alternatives or replacements, which in turn causes the price of things to be a lot more expensive. So in order to battle or to combat inflation, what governments tend to do is they increase the interest rates, and the aim of that is to cool down the economy. So as the cost to actually borrow money increases, people have less disposable income available to be able to go and buy these things. So it's a mechanism that government uses to cool the economy down in the case of where there is inflation. So that's partially why they increase the interest rates. So you may be wondering, how does this affect you, as you don't borrow money from the Fed or the Reserve Bank? Well, the bank that you use, whether it's Bank of America, Chase Bank in the United States, ABSA in South Africa, you name it, they borrow money from the Fed in the United States if they are a US bank, or the South African Reserve Bank if they are a South African bank. But what do? They then pass the increase in the costs onto you. So let's say the lending rate was 5% that the Fed or the Reserve Bank was lending money to your local bank or to the bank that you bank with. What are they going to do? They're going to pass that increase onto you when they are charged more. So let's make it a bit personal. Let's bring it a bit home. Let's just discuss a few areas where it might be affecting you and what you can do. Number one, consumer debt. More often than not, when it comes to consumer debt, like credit cards and maybe even car notes or car loans, they generally have a variable interest rate. And as a result of that, when the Fed or the Reserve Bank increases the interest rate, it filters down to those sorts of debt, which means you're going to be paying a lot more. And not only in terms of your minimum payment, but your interest in the long run. So what would I do if I were you? When it comes to a credit card, I would pay my balance off as and when it becomes due. If you find yourself where you can't do that, I'm going to share a bonus tip at the end of this video with regards to what I would do if I had credit card debt. So stick around until the end, because I believe it will help you. When it comes to your car payment, consider whether or not you can switch to a fixed interest rate. And you might be saying, yeah, but interest rates might swing the other way, but it's going to go up over the next couple of months and maybe the next year or a bit longer than that. So you're going to be paying more if you're going to be finding yourself in a position where you've got a variable interest rate. So the second area that I want you to consider is your mortgage or your bond, depending on where you find yourself. If you've got a fixed interest rate now already, and as opposed to a variable interest rate, you are protected from the fluctuations in the interest rate. Your older loans are protected from the increase, but newer loans will be subject to a higher interest rate. So when you go and you apply for a loan, if you're going to be buying a house on credit, you are going to be paying more because the interest rate is going to be higher. So something I would consider is whether or not you could switch to a fixed interest rate as opposed to a variable interest rate. And you might consider whether it's still early enough to refinance your loan. Right, I know a couple of months ago, the refinance rates were a lot lower than what it is now. But it might still be practical to go out and do that. There's no harm in doing a bit of research and asking. You might still get a better rate than what you're currently getting at the moment. Another thing to consider is if you are in the market to buy a house, maybe now is the time to defer that slightly and to save up a bit more so that you can put down a bigger deposit and you'll end up paying less in the long run. Or maybe you need to consider buying a smaller home now based on what you can truly afford. A bit of advice that I normally tell people, or when I talk to people about buying houses, is never buy a house by borrowing the full amount that the bank or the lenders wanting to give you. So let's say they are willing to give you 300,000. Don't borrow 300,000, because what happens if it is a variable rate and you can just about afford the payment on the original 300,000 at the rate that you signed in, but now the rate goes up, all of a sudden you can't afford to make your payment. And that's how a lot of people go into foreclosure. They end up losing their houses is because they borrow too much and they can't end up paying the money back or paying the installments or paying their mortgage because they just don't have enough disposable income available. Before we move any further, just comment below what your biggest takeaway of this video has been so far. So it might be locking in a fixed interest rate or refinancing your loan, or it could even be just paying your debt off as and when it becomes due. Comment below and let us know what it is that you are going to do or what you learned in this video thus far. The third thing that you need to consider is the impact of the increase in interest rates on stocks that you're investing in. So if you look at stock, you're buying a share in a business, right? But at the end of the day, if they are borrowing money to be able to do certain things like new projects to expand, if the cost of their borrowings goes up, they might not be able to expand at the rate that they want to, which means that they might slow things down. So the value of the stock might decline. That might be a good thing or a bad thing. It might be a good thing if the value declines slightly. So if you've got excess cash, you might be able to buy now when it drops, so that when the market picks up again, you'll make some money. When it comes to investing, I'm a big advocate of invest based on the knowledge that you have. But if you don't have the knowledge to do that, make use of a financial advisor that's a fiduciary that's got your best interest in mind at all times. The fourth thing that I want you to consider is bonds. So if you've got a decent amount of your portfolio invested in bonds, then maybe you need to consider getting newer bonds. Because remember, when you bought into that initial bond, you were offered a particular interest rate, which would have been an old interest rate, which would have been at a lower rate. Whereas you could be getting a higher interest rate on a newer bond with the same amount of risk exposure. So just bear that in mind. If you are finding yourself in a position where a large portion of your portfolio is invested in bonds, maybe you need to switch from the bonds that you have now to newer bonds. And for those that don't know what bonds are at a really high level, an example is if the government wants to embark on a particular project, but they need money, they come to you. You can then buy a bond. They guarantee that they are going to give you your capital back as well as interest. It's generally low risk, so the return on the bond is generally a lot lower than stocks, but you want to consider whether or not you are getting a good rate compared to the bonds that's available in the market. The next area that I want to talk about is savings accounts. So do you know what you're getting in terms of savings at your bank? I recorded a video which is on this channel, and I'll leave a link below this video with regards to what you need to consider when it comes to choosing a savings account. But now may be the time to shop around for a savings account that's going to give you a better interest rate than the one that what you currently are getting. Generally, online savings accounts are able to pay you more, but it's important, again, guys, just to pause and stop. If you don't know what you're getting, go and check it out and make sure that you are being a good steward of the resources that you have, and get a good savings account where you are making more than that 0.06 or 0.05% that your bank might be paying you. So as we wrap this video up, I've got 2 bonus points for you. Number 1, improve your credit score. It's important, guys, especially if you find yourself in a position where you do buy things on credit, like your house and your car, because your credit score affects the interest rate that you will be charged when you go and borrow money in the future. And I know that there's many of you who are watching this video that aspire to do things debt-free, and that's wonderful. By all means, go ahead and do that. I think it's a great aspiration. But there are those of you watching this video that unfortunately are finding yourselves in a position where you do have debt, or that something that you are at peace about doing. So what you need to do is make sure that you've got a good credit score, because again, translates into the interest rate that you're going to be charged, which in turn affects the interest that you'll pay in the long run. And then the final thing we're going to talk about is credit cards. Early on in the video, I said I've got a tip regarding that. Well, here is the tip. If I found myself in a position, let's say I've got a high variable interest rate credit card and I'm just not able to pay the balance off. You know my philosophy. I like my points, but I pay the balance off. Well, let's say I find myself in a position where I can't do that. What am I going to do? I would research and identify if in my country or in my region there is a 0% interest rate credit card, which I can lock that 0% rate in for a minimum of 12 months. Some of them offer 15 months, some offer 21 months at 0%. But then I'm going to pay that balance off. The key is to pay the balance off and not to charge more, because I'm going to save money in terms of interest. But not only that, guys, I find myself in a position where I could be closer to my goal of maybe being debt free, or I could free up more funds by paying this amount off without any interest, which I could then fund a goal of mine. But it's very important when it comes to this, read the fine print. With some of these 0% credit cards, they expect you to pay the full balance off, and if you don't, they end up retrospectively charging you interest on the balance. So just read the fine print. I'm not saying you need to do that. That's what I would do. It's not advice. It's just something that I, Lyle, would do. So as we wrap this video up, guys, I encourage you to share this video with somebody that you feel could benefit from this video. And as always, if you haven't subscribed to the channel yet, subscribe for more videos just like this. God bless you guys. Bye.